Dallas, Texas, summer 2024. Scroll through obscure automotive forums and you will inevitably encounter the modern American myth of the repo auction. The narrative is intoxicating. Inflation is rampant, stimulus checks are a distant memory, and the consumer is breaking. Somewhere out there, the myth suggests, are massive dirt lots overflowing with late model pickup trucks and sedans, waiting to be auctioned off to the public for pennies on the dollar. It is a compelling story that makes intuitive macroeconomic sense. And it is completely, fundamentally wrong. The percentage of auto loans transitioning into serious delinquency has climbed to levels unseen since the Great Recession. Repossession agents are working overtime, but the cheap repo car is a ghost. Used car prices remain historically elevated. If millions of cars are being repossessed, why are they still astronomically expensive? To answer that, you have to stop looking at the economy like a consumer and start looking at it like a forensic accountant. Subscribe to Capital Curriculum. We are mapping the hidden financial plumbing that controls the American auto market. Charlotte, North Carolina. A cramped apartment kitchen. A borrower stares at a past due notice for a 2021 Honda Civic. The monthly payment is $740. They are 90 days late. During the pandemic, supply chain disruptions crippled new car production. Desperate consumers flooded the used car market, driving prices up by more than 40%. Lenders, flush with liquidity and emboldened by stimulus-padded bank accounts, originated millions of auto loans at highly inflated vehicle valuations. Fast forward to the present. The stimulus money is gone. The Federal Reserve hiked interest rates at the fastest pace in 4 decades. Household budgets are squeezed to the absolute limit. A slow-motion wave of defaults is washing over the country. Subprime auto loan severe delinquencies have hit an annualized rate of over 6%, the highest in nearly 3 decades. Americans now hold over $1.6 trillion in auto loan debt. The water pressure in the plumbing is at maximum capacity, threatening to burst the pipes. You look at these numbers and the logic seems incredibly simple. An observer says, millions of borrowers are defaulting. That means a tsunami of repossessed cars is hitting the market today. That massive supply glut will crash used car prices through the floor. The seasoned auto analyst shakes their head and replies, "You are assuming a delinquent loan immediately equals a physical car on a public auction block. That is not how the machine works." The observer asks, "But if they do not pay, the bank takes the car, right?" The analyst laughs. The bank does not want the car. The bank wants the yield. A physical vehicle is a depreciating liability. The moment they seize it, they have to recognize a catastrophic loss on their balance sheet. This is the first fundamental misunderstanding of the auto market. The pipeline from a defaulted loan to a wholesale market is not a straight drop. It is a massive, intentionally engineered time lag, designed by the institutions at the very top of the funnel. When you picture a bank, you might imagine a concrete vault stacked with cash. But a bank's balance sheet is actually a ledger of promises. To a lender, an auto loan is a high-yielding asset. The physical car is a volatile liability. When a borrower defaults, the lender is faced with a stark mathematical reality. The vehicle is almost certainly worth less than the outstanding balance of the loan. This is negative equity, colloquially known as being underwater. The average negative equity on traded-in vehicles recently reached nearly $6,000. For repossessed vehicles, that number is exponentially higher. Distressed borrowers tend to skip routine maintenance like oil changes and tyre rotations long before they skip the actual car payment. This accelerates the vehicle's depreciation. By the time a lender reclaims the asset, the math is horrifying. A borrower owes $20,000, but the neglected sedan is only worth $10,000 at wholesale. Taking the car back means swallowing that loss immediately. That is terrible for quarterly earnings. When a lender orders a repossession, they are not just taking a loss on the vehicle's depreciated value. They must pay the repossession agent a hook fee. They must pay daily storage fees at the impound lot. They must pay for heavy transport to a wholesale auction. They must pay auction seller fees and administrative costs to wash the title. By the time the car is finally sold, a bank might take a $15,000 loss. They can legally sue the borrower for this deficiency balance, but a borrower who cannot afford a $500 car payment certainly cannot afford a $15,000 judgment. It is entirely uncollectible debt. Because repossession is an incredibly expensive, loss-realizing event, the banks refuse to let the floodgates open. Instead of sending out the tow trucks, they pull a hidden lever to artificially restrict the supply of repos entering the market. This single maneuver keeps millions of phantom cars off the lot, and it is happening in risk departments across the country right now. Detroit, Michigan. The risk mitigation flaw of a major subprime auto lender. Rows of analysts monitor dashboards flashing red with 90-day delinquencies. The traditional protocol dictates that once an account hits this threshold, a repossession order is instantly dispatched. But today, the directives have changed. Instead of dispatching trucks, the call center representatives are dialing phones. The banks are intentionally slowing the flow of repossessions to avoid recognizing massive, catastrophic losses on their quarterly earnings reports. The millions of defaults are being heavily bottlenecked at the lender level. The strategy is simple: delay the pain at all costs. The analysts are armed with aggressive loss mitigation software designed to keep the borrower in the vehicle, even if the borrower has not made a full payment in 4 months. The goal is no longer to collect the principal. The goal is simply to keep the loan marked as performing on the ledger, preventing the asset from physically entering the secondary market and crushing wholesale values. A collections agent gets a distressed borrower on the phone. The borrower says, "I lost my overtime shifts. I cannot make the $600 payment this month." 10 years ago, the agent would have replied, "We are sending a truck to your driveway tonight." Today, the agent says, "We have a hardship program available. We can offer you a 3-month forbearance. We will simply tack those missed payments onto the back end of your loan." The borrower hesitates. "But my loan is for 72 months. The agent counters, "We can restructure the entire note. We will extend your term to 84 months, lowering your current monthly payment to $400. The borrower agrees, relieved to keep the car. The bank is relieved because they do not have to write down a $10,000 loss today. This conversation is happening thousands of times a day across the United States. It is a massive, coordinated effort to artificially delay the inventory from ever reaching the wholesale auction block. This practice is known as extend and pretend. Lenders are deploying it at scale. By modifying the loan terms, they can legally classify a delinquent asset as a performing asset, kicking the can down the road. But when phone calls and extensions fail, lenders deploy hardware. Millions of subprime vehicles are now equipped with GPS starter interrupt devices, commonly known as kill switches. When an account goes dangerously past due, the lender sends a digital signal to the vehicle's onboard computer. The next morning, the car simply refuses to start. The bank has not physically repossessed the car. They are not paying storage fees. They are not paying auction fees. They are merely holding the vehicle hostage in the borrower's own driveway. The bank hopes the extreme inconvenience forces the borrower to borrow money from family or secure a payday loan to scrape together a partial payment. The kill switch acts as a localized pause button on depreciation, further starving the broader used car market of available inventory. Eventually, however, the math runs out. The forbearance periods expire, the borrower ignores the immobilized car in the driveway, and the risk department has absolutely no choice left. They must clear the dead weight off the balance sheet. A manager clicks a button on their terminal, and a formal repossession order is dispatched into a digital queue. The bank is finally willing to take the hit. Logic dictates that the car should now be swept quickly into the market, adding a unit of supply and incrementally lowering the cost of used cars for everyone else. But the institutional lenders have inadvertently created a second, physical wall in the plumbing. Getting the legal right to take a car is easy. Actually finding a human being to drive a heavy-duty tow truck into a hostile neighbourhood at 3 a.m. to retrieve it is a completely different nightmare. The banking system is about to collide with the brutal logistical reality of the American repo industry. Houston, Texas, 2 a.m. The air conditioning is humming inside a battered Ford F-450 tow truck. The driver is staring at a laptop mounted to the dashboard. Above the cab, infrared license plate recognition cameras scan the dark rows of a sprawling apartment complex. They read thousands of plates an hour, searching for a single match against a digital hot list. The repossession industry is in a state of catastrophic logistical failure. According to trade groups representing recovery professionals, the industry has lost nearly a third of its workforce since 2020. During the pandemic, moratoriums on repossessions, smaller agencies went completely bankrupt. Their tow trucks were sold off to scrapyards. Their drivers walked away to find less dangerous, higher-paying jobs delivering packages for logistics giants. Today, there simply are not enough trained agents or physical trucks to repossess the massive volume of defaulted vehicles. Even when the banks open the floodgates, the repo industry is structurally incapable of handling the water pressure. A local repo agency owner receives a call from a national forwarding company, the middleman software platforms that banks use to dispatch orders. The forwarder says, "We have 50 open assignments in your zip code. We need them picked up this week." The repo boss replies, "I only have 3 trucks running. Diesel is up, my commercial liability insurance has doubled, and a new wrecker costs $120,000. I need $500 a car just to break even." The forwarder firmly answers, "The bank is only authorizing a standard hook fee of $350. Take it or leave it." The repo boss hangs up the phone. For over a decade, lenders have flatly refused to raise the baseline fees they pay recovery agents. This brutal economic squeeze has completely hollowed out the industry's capacity. Agents are cherry-picking only the easiest, closest targets, leaving hundreds of thousands of active repossession orders rotting in the system. The cars are out there, but nobody is coming to get them. Because repossession agencies are financially suffocated by the banks on the initial hook fees, they are forced to make up their profit margins elsewhere. They do this through storage fees and personal property processing. Once a vehicle is finally hooked, it is towed to a heavily fenced local lot. Here, state laws mandate a strict holding period, usually 10 to 21 days, granting the borrower a final window to cure the default and redeem the vehicle. This legal waiting period turns repo yards into highly lucrative parking lots. Cars languish in the dust, racking up $40 daily storage charges. The process is painfully slow, bloated with administrative paperwork, and incredibly adversarial. Before a lender can even think about selling the vehicle, the title must be legally washed and cleared by a state municipality. A seized car can easily sit stagnant in a regional holding yard for 30 to 60 days before it is ever cleared for transport to the next stage of the financial plumbing. This extreme logistical bottleneck means that even if a major bank orders 100,000 cars for repossession today, they will only trickle into the actual market by the hundreds, stretched out agonizingly over several months. Supply is ruthlessly throttled yet again. But let us assume the hypothetical vehicle survives this gauntlet. The waiting period has expired, the title is fully cleared, and the bank arranges for an 18-wheeler to transport the unit away from the local yard. Surely this is the moment the cheap repo car arrives at a public auction, ready for a retail buyer with $5,000 in cash to drive it home. Absolutely not. The vast majority of these recovered assets will never see the light of a public market. They are about to be swallowed by a highly guarded, institutional-only oligopoly that legally bars the retail consumer from ever participating. Welcome to the invisible marketplace, where the true price of every vehicle in America is secretly dictated. Atlanta, Georgia, inside a massive command center. There are no fast-talking auctioneers with gavels, no tire kickers smelling the interiors of used sedans. Instead, rows of silent servers process millions of bids per second. This is the wholesale auction oligopoly, dominated by corporate giants like Manheim and Odessa. This is the hidden digital pipeline where the nation's repossessed inventory is liquidated. It is a strictly closed loop. You must possess a valid dealer license to even log into the portal. In the past, wholesale auctions were deeply localized physical events. A repossessed truck in a depressed Rust Belt town might sell for dirt cheap because local dealers simply lacked buyers with cash. Today, platforms like Online Vehicle Exchange and Manheim Simulcast allow dealers from across the globe to bid on vehicles in real time. This digital revolution completely eliminated geographical arbitrage. A desperate dealer in booming Austin, Texas, can outbid a dealer in Ohio with the click of a mouse, ensuring national prices remain permanently elevated by the wealthiest markets. A used car dealer from Florida is staring at his computer screen, watching a repossessed 2019 Nissan Altima roll across the digital block. The bidding stalls. The dealer types his final offer into the chat box. "I will give you $12,000 for the Nissan." The digital auctioneer instantly replies, "The floor is $14,000 if no sale." The dealer types back, "The tires are bald and the transmission is slipping. It is only worth 12." The auctioneer repeats, "No sale." The car returns to the yard. The vehicle rolls off the block, unsold. When a massive institutional lender consigns a repossessed car to a wholesale auction, they never list it with no reserve. They utilize sophisticated, high-frequency algorithms that calculate the exact market value of the vehicle down to the zip code. The lender places a hard, unyielding floor price on the asset. If the live bidding does not meet this algorithmic threshold, the auction completely halts. The bank refuses to take the discount. This practice is technically known in the industry as managing depreciation. It acts as an unbreakable dam within the financial plumbing. Lenders are terrified of a concept known as clearing prices. If they dump 20,000 repossessed Altimas at whatever price the market will naturally bear, they will instantly crash the Manheim Market Report Index. The MMR is essentially the Wall Street stock ticker for the used car industry. Banks would much rather pay Manheim a daily storage fee to let a car sit rotting in a back lot for another month than sell it below their algorithmically determined floor. They are actively utilising the auction houses as holding pens, artificially restricting the available supply of vehicles to retail dealers. By tightly controlling the drip of inventory, they maintain artificially high wholesale prices. The banks act as a unified cartel, an OPEC for used cars, strictly limiting production to ensure the barrel price never drops below their profit margins. Eventually, a desperate dealer bites. They agree to meet the algorithmic floor price and purchase the repossessed Altima for $14,000. The car finally exits the wholesale oligopoly and enters the retail plumbing. But any hope of a cheap car is about to be obliterated by dealership Alchemy. The dealer owns the car for $14,000, but it is a rough repossession. The previous owner smoked cheap cigars in it for 3 years. The brakes are grinding metal on metal, and it needs a complete fluid flush. The vehicle must pass a state safety inspection before it can legally be parked on the retail lot with a price sticker in the window. The retail consumer has no idea how expensive it is to operate a dealership in a high inflation environment. The internal costs of transforming a filthy, neglected repo into a presentable family sedan are skyrocketing, and every single cent of that financial burden is about to be violently passed down to the next buyer. Suburban Chicago, Illinois. A mechanic wipes his grease-stained hands on a rag, staring at the Altima on the hydraulic lift. According to industry data, the cost of vehicle reconditioning has exploded. Lingering supply chain fractures, union strikes, and generalized inflation have pushed auto parts prices up by 20 to 30% over the last few years. Mechanic labor rates at dealerships routinely exceed $150 an hour. The dealer spends $2,500 just to make the Altima mechanically safe and visually presentable. The dealer now owns the car for $16,500. But the financial bleeding does not stop in the service bay. Dealers almost never purchase inventory with their own cash. They rely on a specialized, revolving line of credit called floor plan financing. Because the Federal Reserve aggressively raised interest rates, the interest the dealer pays on their daily floor plan has skyrocketed. The clock is ticking the second the car arrives on the transport truck. The sales manager walks into the dealer principal's office. The Altima is out of recon. We are into it for $16,500. How do we price it? The owner points to a spreadsheet. My floor plan interest is eating me alive. Every day that car sits on the blacktop, it costs me $30 in interest. I have to cover the auction buy fees. I have to cover the massive reconditioning bill. I have to pay the salesman his commission. I have to pay the electric bill for the showroom lights. The owner taps the desk. Price it at $19,999. We do not have a choice. The manager nods. The cheap repo car, seized from a defaulting borrower months ago, has now been financially bloated by transportation, storage, algorithmic floor pricing, reconditioning inflation, and commercial interest rates. By the time it finally reaches the retail consumer, it is priced exactly the same as a pristine, privately owned vehicle. But what happens to the truly destroyed vehicles? The older repos with 150,000 miles that traditional dealers refuse to touch. They fall into a dark subsector known as buy here, pay here. These lots cater exclusively to deep subprime borrowers with credit scores in the 500s. At these lots, the dealer is the bank. They buy a terrible car at auction for $4,000. They do zero reconditioning. They slap a $9,000 price tag on it. But they do not expect the customer to pay $9,000. The entire business model is based on harvesting down payments from the working poor. They demand $2,500 down, finance the rest at a 29% interest rate, and install a GPS kill switch. 6 months later, when the engine knocks and the customer defaults, the dealer activates the switch, repossesses the car using their own tow truck, and puts it right back on the lot for another down payment. This is the subprime recycling loop. Older, high-mileage repos are not getting cheaper. They are being utilized as physical financial instruments to extract rolling down payments from vulnerable consumers. It is a wildly lucrative model, ensuring that even junk inventory maintains a high intrinsic value at wholesale auctions. The floor of the entire market is heavily supported by dealers who know they can squeeze $10,000 of cash flow out of a $4,000 piece of scrap metal. From the traditional dealer to the deep subprime lot, the retail pricing mechanism is ironclad. But you might be wondering, why do the massive national lenders care so deeply about the wholesale value of these cars? Why are they so terrified of a localized price drop that they will orchestrate this entire nationwide scheme of managed depreciation? The answer lies far beyond the local car lot. It requires a direct look into the heart of Wall Street and the multi-billion-dollar derivatives market propping up the American economy. Lower Manhattan, New York. A high-frequency trading desk overlooking the East River. Billions of dollars are shifting across screens in milliseconds. Auto loans are rarely held by the local credit union or national bank that originated them. The risk is too highly concentrated. Instead, they are bundled together by the tens of thousands into complex financial derivatives known as auto asset-backed securities. An originator writes 10,000 auto loans totaling $250 million. They immediately sell this massive pool of debt to an investment bank. The investment bankers chop this pool up into various tranches based on risk profiles. The safest, AAA-rated slices are sold to conservative institutional investors like state pension funds and massive insurance companies. The riskier equity tranches are sold to aggressive hedge funds seeking massive yields. This securitization machine is the invisible engine of the auto industry, supplying the endless liquidity needed to originate more loans. But this entire paper castle is built on one very specific, highly fragile physical foundation. A portfolio manager at a pension fund calls the investment banker who sold him the auto asset-backed security. I am seeing the severe delinquency data. Borrowers are defaulting on these loans. How exposed are my AAA bonds? The banker replies calmly, "Your bonds are fully insulated. The trusts are over-collateralized. Even if a borrower stops paying, the trust repossesses the vehicle and liquidates it at auction. Our recovery rate on those vehicles is 65%. The pension manager narrows his eyes. But what if wholesale used car prices suddenly crash? What if the recovery rate drops to 40% because you flood the auction block with repos? The banker pauses. If the recovery rate plummets, the trusts will begin taking massive losses. The credit rating agencies will downgrade the bonds. You will be legally forced to liquidate your position, triggering a massive panic in the credit markets. The banker exhales. Do not worry. We will never let used car prices crash. We control the supply. This is the securitization firewall. The massive auto lenders are the primary issuers of these bonds. Their entire corporate existence relies on Wall Street buying this packaged debt. If wholesale prices drop, the underlying collateral loses its value and the bond market freezes. Therefore, the financial system must keep used car prices artificially high at all costs. But they have a silent partner in this endeavour, the global automakers. Prior to 2020, Detroit and Tokyo ran their factories 24 hours a day, wildly overproducing new vehicles. They dumped millions of excess cars into daily rental fleets, which eventually flooded the used car market, providing a constant stream of cheap inventory. The pandemic chip shortage taught the automakers a highly profitable lesson. Scarcity pays. By intentionally producing fewer cars, automakers eliminated cash on the hood incentives. They posted record corporate profits despite selling fewer total units. They severely restricted sales to rental fleets, fundamentally starving the entire downstream secondary market of quality, late-model used vehicles. This engineered scarcity from the manufacturers places a massive, permanent upward pressure on the price of every single used car in the pipeline, repossessions included. When a repossessed Toyota Camry finally survives the forbearance delays, escapes the broken tow truck logistics, clears the title washing, and meets the algorithmic floor price at a digital auction, there are 5 desperate retail dealers violently fighting over it because they cannot source fresh inventory anywhere else. The lack of new car overproduction guarantees that demand at the wholesale level will permanently outstrip supply. The asset is simply too valuable to the macro financial system to ever be handed over to a retail buyer at a discount. You are not just buying a piece of metal with 4 wheels. You are attempting to purchase the underlying collateral of a multi-billion-dollar Wall Street derivative in a market deliberately starved of supply by the manufacturers. You are playing a rigged game against the house, and the house has infinite leverage. The auto loan crisis is absolutely real. The pain felt by the American consumer, suffocating under the weight of 10% interest rates and $700 average monthly payments, is severe. Defaults will continue to steadily rise. Subprime vehicles will continue to be towed away in the dead of night by LPR camera trucks. But those cars are not returning to a free, localized market. They are being completely absorbed by a financialized machine meticulously designed to protect institutional capital at the exact expense of retail affordability. The era of the cheap, reliable used car is dead. Welcome to the permanent era of managed depreciation. The next time you see a viral video promising secret dirt lots full of abandoned, heavily discounted trucks, remember the hidden plumbing. The system is operating exactly as it was designed to. If you want to survive the financialization of the American economy, you must understand how the machinery actually works. Subscribe to Capital Curriculum. The real education has just begun.